In this video, we're going to have a quick look over at the financials of BlackRock, a massive American private equity firm that has about $9 trillion under management. They are often called the company that owns the world, which is obviously not true because obviously the world is owned by lizard people. For legal reasons, that's a joke. Anyway, let's have a look here over at their financials and see exactly what they have been doing for the past 10 years. BlackRock is an asset management company, which means that most of the assets that they hold are not actually even theirs, but they do operate with those assets and they charge an operating fee to manage those assets as well as a success fee based on the amount of profit they make every single year, which is also known as carried interest in the private equity world. Anyway, let's have a quick look over their financials and see whether or not we think if we buy the stock today and hold it for a decade, can we expect to outperform the market? I would very much like to say that BlackRock is a very complicated company and just all the numbers that I will show you in this Excel spreadsheet only scratches the surface of what BlackRock actually does. So if you do actually want to invest in them, I very much recommend that you read the 10Ks, read the annual reports and see exactly what BlackRock has been up to for the past 10 years. Their revenue numbers here has been growing by about 6% annually for the past 10 years, and so has their EBITDA by about 5% every single year. 4 billion EBITDA in 2013, about 7 billion EBITDA in 2022. Their debt level is easily manageable by the amount of cash they have as well as by the amount of earnings that are coming in every single year. Therefore, I don't think that BlackRock is in any way over leveraged right now, which is actually a very nice thing because most private equity firms are in quite a bit of troubled water because of the rising interest rates. Private equity companies play a lot with debt and leverage buyouts, and of course this is also what BlackRock has been doing here in the past and will be doing in the future as well. But as of right now, their balance sheet is quite clean. Their market cap has been increasing by 7% annually, and so has their enterprise value. The enterprise value is the entire value of the business. So you take the market cap to which you then add the debt and you subtract the cash. Their EV/EBITDA ratio has been around 16 times here for the past 10 years. In 2022, we also saw 17 times, 21 times here in 2020, which is quite a high number, all things considered. And I think right now they're quite close to their 10-year average. This means that it takes them about 17 years of EBITDA, so earnings before interest, taxes, depreciation, and amortization, to buy back the entirety of their enterprise value. Their net debt to EBITDA ratio for the past 5 years, 6 years has been around 2.2 times because I did not have the numbers here for the first 4 years when it comes to their debt and excess cash numbers. Nevertheless, for the most part, they have been underneath the 3 times ratio, which is always like the cutoff point that I like to use to see whether or not a company is over leveraged, yes or no. So this then brings us to their cash flow. And their cash flow gives a very similar image as their earnings does, which is to say that their cash flow from operation has been increasing by about 3%, almost 4% here for the past 10 years. Then we subtract the capital expenditure, and of course the capital expenditure is all the costs that they have to make every single year to keep on operating their business. I think it's important to realize that BlackRock, because they are an asset manager, they basically get a fee from all the assets that they manage. They don't have a lot of capital expenditure because they don't actually own a lot of the hard assets themselves. They own a lot of stocks in companies like Apple or Microsoft or whatever have you, and also they own some of their own companies, but this is very negligible compared to their overall portfolio. Therefore, their capital expenditure is quite low, all things considered. If you take the cash flow from operation and you subtract the capital expenditure, you get the free cash flow, which is basically your pro rata ownership of the company. This is all the money that's available to you as an equity owner at the end of the fiscal year. And with this money, they can do several things. They can pay a dividend, they can buy back stock, they can lower their debt level, or they can do additional acquisitions or expansions. BlackRock very much does pay a dividend every single year of about 3% currently, with the current market price of $660. They also have been buying back shares consistently as an additional way to really reward their shareholders. And we can see that for the past 2 years, they've also been buying back a lot of debt. And I also don't doubt that they've been doing acquisitions and mergers as well. So this very much shows that BlackRock is using their money in any way possible. Free cash flow per share is what you get when you take the free cash flow, you divide it by the amount of shares outstanding. And we can see that this number has been growing by around 4% annually. Their free cash flow is growing by about 2%, their shares are decreasing by about 1%, and therefore the free cash flow per share is increasing by about 4%. The overall share price as seen on the open market itself has been increasing by 9% annually, and this number does not in fact include dividends. You get that additional percentage on top of the price per share increase that we see here for the past 10 years of 9%. An average free cash flow yield of about 4.2%, which basically means that they rake in about 4% of free cash flow per share compared to the total share price at that very moment. In other words, $29.10 is 4% of the overall share price at that year of $720. Which basically means it takes about 25 years of free cash flow per share to buy back the entire value of one share. So these are the numbers for BlackRock. Let's try to forecast this company into the future, and I'm going to do this by giving them an EBITDA growth of 4% for the first 5 years and 3% for the last 5 years. Historically, they have been growing a bit faster than that, but I want to be a bit more conservative whenever I make an estimate. Because if my conservative estimate beats the stock market, that's when I'm going to be interested in buying this stock. Taking the multiple of 16 times, which is their historic average, this gives me an enterprise value 10 years from now of $153 billion, from which we then subtract the debt, we add the cash, giving us a market cap of also around $150 billion. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. This gives me an overall share price 10 years from now, so in 2032, of $977.10. If we take the free cash flow method and we do a very similar free cash flow growth as we did with our EBITDA numbers, also attaching the 4% free cash flow yield, which is around their average number, this gives me a stock price 10 years from now based on the free cash flow model of $1,026. Right now on the open market, we can buy as many shares of BlackRock as we want for $660.10. Giving both my projections of the enterprise value as well as the free cash flow method, this gives me an average share price 10 years from now of just over $1,000. Simply looking at the price on the stock market alone, so the compounding annual growth rate of the stock price, this gives me an increase of about 4.3% annually. But the moment that we include the free cash flow that we have projected here in this very model, we get an IRR of about 10%. Because this free cash flow then includes additional share buybacks, it includes additional dividends, which are not included in the compounding annual growth rate. Overall, I always say that 10% is about the average that the S&P 500 returns, so the overall market average is around 10%, and I expect BlackRock to do very much the very same thing. But let's see what happens if the price goes up or comes down a little bit. So we have seen here that in 2021, their share price was $918. If it reaches that number again, so it increases the share price by about 40%, I expect an IRR of well below the 6%, which is definitely underperforming the overall market trend. But the moment that the price comes down a little bit, let's say to the 600 range, maybe even the 500 range, I expect an IRR between the 11.6 and 15.3%, which is definitely a very attractive return. And given that BlackRock is a massively diversified company, the immediate risk of bankruptcy or the immediate risk of underperforming or outperforming the market are quite minimal. I think BlackRock is a very steady stock to hold in your portfolio, given the broad range of companies that it holds. So that was it for BlackRock's financials. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!